Alright everybody, welcome back to the second video of multicollinearity. So in this video, I thought we would take a look at a couple of indicators that I find myself using all the time. Now, honestly, a lot of the indicators that I use are really just automatic drawing tools. For an example, on the candle chart in front of you, the big candle chart here, not the one on the left side, but the big candle chart, we have these cyan lines and these yellow lines. Now I could have just drawn those by hand. They're not doing any special calculation or formula or anything like that. They are not doing something that I couldn't do myself. One thing about this indicator that we can't do is if we miss our window of opportunity. What this indicator is doing is it's recording the expected move for a week, and it locks these lines into place on Friday afternoon at the close. So all through the weekend, between Friday night at 6 o'clock and Sunday night at 5:59, you could just go and look at the expected move in here on the options chain. You could do that. So that would be one way that you could get the expected move. The problem is on Sunday night at 6 o'clock, when the market opens into Globex, these expected move numbers, they start to change. And so if you didn't get those numbers sometime over the weekend, and say on Monday morning you decide, gee, I wonder what the expected move for the coming up week is from last Friday, you won't have it. Now, if you've done some options trading, you might be wondering why I wouldn't want a more current expected move. And I get that. That is a very valid question. And there are indicators that will do that for you. But this one particular indicator, it locks in that expected move on Friday for a reason. Now, I'm not going to get into what this indicator, what the reasons are behind it. It was specifically designed for the ES for locking in that expected move on Friday. If you did want a more current expected move, something that is dynamic and is actually updating as the market updates, well, great, go get one of those indicators. I wanted this one for a reason. So I use this one a lot. I also like the fact that it has locked those lines, and I can look back and I can do a lot of research with this line. So I really like it. But like I said, this indicator, it's not doing something that I couldn't do. I could draw the lines myself on Friday afternoon or Saturday or Sunday. And I have drawn my own lines. I've drawn them and I keep them unless I accidentally wipe them out. They are on there. And, I can go back and I can look at what I have drawn. And that's fine too. It's no big deal. So that's one indicator that I use all the time. And it's a very powerful indicator. I use this for 18 different options trades. I also use it for futures trading, and I use it to perform analysis in the overall market. I actually make determinations of market direction with this thing. I do a lot of things with this indicator. So it's a very, very powerful indicator to me. Another indicator, and one of the first indicators that I ever learned to use and that I actually used in trading, the stochastics slow set to a 5-1. Now, I used to use this set to a 5-3. Now I use it at a 5-1. There are a lot of different stochastics out there. I like this one. So other than the setting of 5-1, I haven't made any adjustments to it. And I use this on very selected products. Now you can use it all over. I don't. I use it on things that already are very good, very strong markets. I don't use it on futures. I just happen to have had it up. but this indicator, I like to use it on a daily time frame, and I treat the indicator a lot like the perspective that you would have at a basketball court or at a football stadium. Everything starts in the middle. So from the middle, in a bullish market, we would expect the indicator to go up, maybe cross 80, magnetize across the top like it did over here. And when the market pulls back, I would want to see an opportunity to join in when price is making that pullback, to find an opportunity to join in. And that pullback, I would like to see that it coincides somewhere at or around that 50 line. That would be a really nice pullback signal or pullback opportunity. What I don't want to see is the stochastics pull all the way down to the 20. That I don't like to see that. Okay? Think of the Fibonacci. When you measure with Fibonacci and price pulls back to the 786, hey, great. If it pulls back to the 618, oh, yeah, that's doable. If price pulls back to the 50 line on a Fibonacci, you begin to think maybe that's not a pullback, right? That perhaps we're looking at a change in market sentiment or a change in direction. It's kind of the same thing with this. When I see across the 50 and maybe we get a little deep, not too bad, we stay above the 30, all right, I'm good with that. When we cross down below the 20, now I'm beginning to think that maybe I'm not so good with that. Okay? And I look at it as a warning. Not that a market's failed or that I need to go short or anything like that, but I get real suspicious of that pullback. Okay? This is an indicator that I've used since the very beginning of my trading. And what I like to do is find a signal on the daily or the weekly or the monthly. And then if I determine from this signal that the market is in a pullback, I go to the intraday, the 2-hour or the 1 hour, and I look for an opportunity to join into the market. I do a lot of analysis this way from the daily time frame, getting an actionable trade signal, and then going into the intraday and only looking for those opportunities to join the direction. So, like right now, for an example, when we are below the 20 and we pull back near or at the 50 and then roll over, that is a continuation of a bear play. Okay, that I like to see that. That's a pullback, right? A pullback before continuing to go short. If I seen that signal on the daily time frame, I would go into the intraday and begin looking for short trade opportunities. Now that doesn't mean that I'm just going to go and put on a swing trade and go short, but as a day trader, I may take a signal like that into the intraday and begin looking for those short trading opportunities. If I don't get one, okay, fine, it's no problem. Maybe something on this intraday time frame would tell me not to take that bearish position, that I should go ahead and remain bullish. Remember, trends are identified from the higher time frame, but a trend reversal starts on the lower time frame. Okay, so I might see a trade signal or a pullback in a trade in a continuing market, and then on the intraday I might identify that that trend has ended or that the continuation has died and that we should be looking for a reversal. Okay, but I like to begin with the concept of what should I be looking for? Should I be looking for bullish opportunities or should I be looking for bearish opportunities? And I'll use those higher time frames to give me that analysis. And I've found the stochastics slow 3 to be an effective tool to do that sort of analysis. Alright guys, one more indicator for this video. The implied volatility indicator And on Thinkorswim, it should only be used on the intraday time frame or on the daily time frame. Never, never use this on the intraday. The implied volatility indicator, the modified version that I have here, shows me the daily standard deviation. It's an expected move, a one standard deviation expected move from the daily time frame. So this is showing me that in the next day, this market could move $60 higher or $60 lower from its current location. Now this is a daily number, and if we go into the options chain, we can see here 61.99, and yet this number right here 36. Okay, so this daily indicator is not measuring the September 20 one-day option. It is measuring the September 20 3-day options. Okay, now I can't tell you why it's off. The code for Thinkorswim is just off. Okay, one thing is, if you've watched my volatility series, this indicator is measuring the forward expectation of price movement from the chart. This implied volatility indicator is an implied volatility average of all of the out-of-money calls and puts here in the options chain. So that could be one reason that they're off. But obviously this number is very close to this 3-day number and not the 1-day number. Maybe it's because it's the weekend or it's Sunday night. I can't tell you. But I do like seeing that range. Okay? And I've just grown comfortable with the idea that it's not this number. It's this one. And I can just go in and look. I can see, okay, that's the 3-day, not the 1-day. It's the 3-day. Okay, that's fine. It's no problem for me. It's Wednesdays, not Mondays. The next thing about the implied volatility indicator is I want to actually know where the implied volatility is. I want to know, is it low or is it high? Now, if you've never really looked at implied volatility before, you might think that there's some specific number that would tell me, oh, that's a high number or that's a low number. But every market has its own implied volatility. And if I said that the ES has an IV of 50, would that be high or not high? Well, it's at 28 right now, and it's showing that 28 is really low. We can tell that it's really low because the rank is 16. So if I was to double that to, say, 56, maybe the IV rank would go closer to 50. Okay. One more thing about the implied volatility indicator, I want to see what direction it's pointing. Is the implied volatility getting bigger? Is it going up? Or is the implied volatility getting smaller? Is it going down? Which direction is it going? Now, it ties completely and totally right into this other indicator, the expected move. Every single week, in the last 3 weeks, the IV has been going down. Look at how big this box is. That's the total range of the expected move for that week. That is way bigger than the range for the next week, which was also way bigger, not way bigger, but bigger than the range that we have for this week. Okay, that alone tells me that the IV is going down. This slope also tells me that the IV is going down. They're in agreement. All right. Why does that matter? Well, this indicator is getting its expected move from the options chain. This indicator is getting its expected move from the candles. They're in agreement. That's not always true. So it's nice to see that they are in agreement. Now, depending on the kind of trading that I do, or that I'm trying to do, I might not have this indicator on, or I might not have the implied volatility indicator on. It really just depends on what it is. Am I trying to take a swing trade in stock? Am I trying to take a day trade in futures? Am I building an options position? It really just depends on what it is that I'm doing. Those indicators are not universal. I wouldn't want to use them on everything. For an example, this expected move, it seriously was built for the S&P. Now, I will use it on other products, QQQ, IWM, even ETF products or equity products. I'll go look at Caterpillar and Apple. It wasn't necessarily designed for those, but because I know all the ins and outs of this indicator, I'll use it there, sparingly, specifically. But the fact is, I know all about these three indicators. I've studied them so much. The stochastics was the very first indicator that I ever used, and I have trading strategies, fully formed, actionable trading plans that go to the stochastics. And it has served me well. It's great strategy, great indicators. So guys, I do appreciate your time, and I hope that this video gave you a perspective of how to avoid multicollinearity, or that when you are using something that is looking at implied volatility, that you understand the nuanced differences of what that indicator is doing and why I or you might want two of them that are both looking kind of in the same direction. All right. I appreciate your time, and I look forward to seeing you at the next indicator video.